All right, well, I will go ahead and get us started since we have quite a few attendees. First and foremost, I'd like to thank everyone for joining. My name is Adeola Ogunwole, and I'm Senior Director for Marketing here at sennder, and I would like to welcome you all to our webinar on resilience for road freight shipping in logistics, and how using digital platforms can help you overcome some of the challenges in the European environment. I'm really excited that we can share some of these insights in terms of the macroeconomic trends that are affecting road freight logistics today, and then also share some key insights that we've seen in terms of how shippers can help overcome some of these macroeconomic trends using digital tools. For this webinar today, we would love to also make this a bit more dynamic. So we'll be sharing some more insights in terms of what we can see in terms of these trends, but please do use the Q&A section that you see in the webinar. So that should be at the bottom hand. If you have any questions along the way, please fill those in. We will be addressing questions and answers at the end of the call. All right, but to get us started, all right, actually, hopefully you all can see my screen. Hold on one second, having some technical difficulties here. All right, I think we're back up and running. Hopefully you can see my screen now. Fantastic. And then joining me today on our team, I have Brennon Chen, who's our Director of Strategy and Planning, and Nick Fraser, who's an associate in our Strategy and Planning team. And they'll actually be walking you through many of these macroeconomic trends that are affecting road freight and shipping logistics today. Without further ado, I will hand it over to Brennon to kind of get us started. Brennon.
Thanks, Adeola. It's a pleasure to be here today. So if we go to the next slide, I'll start with an overview of the primary trends we're witnessing in the road freight market in Europe. As you can see listed here, over the last 12 to 18 months or even longer, there have been some overarching trends in the industry. First, of course, fuel. It's no secret that following the peak of COVID lockdowns, fuel prices have been on a significant upward trajectory. And this is a topic that we will be deep diving into later in this discussion. But in addition, the industry has been experiencing a chronic shortage of available truck drivers. At the peak, it was estimated that across Europe, we had a gap of roughly 300 to 400,000 drivers needed to meet the necessary demand. And it's important to note here that reports are suggesting some early signals of easing as pay has improved and training and testing resumes. So for example, in the UK, we've seen a roughly 35% improvement in the driver gap compared to the peak when roughly 100,000 additional drivers were needed in the second half of last year. However, even with these reprieves, of course, on top of the driver shortage, we're also in need of trucks. Early last year, semiconductor manufacturers began signaling an inability to meet rising demand. And at this point today, truck manufacturer order books are so full that new truck orders carry an estimated 12-month or even longer delivery date. I think as a product of these delays, we're seeing that even anecdotally, some used trucks are being sold at new truck prices. So I think that's just a little snippet to give you a sense for how unprecedented we are facing, the gaps we're facing in the market today are. At this point, it's hard to predict when we expect that this shortage will normalize, although I think fairly confidently we expect that that won't really occur until 2023 at the earliest. And finally, on the bottom, we're witnessing global shortages of raw materials and other input goods that are coupled with post-COVID spikes in consumer and business demand. And if we click one slide ahead, so specifically in 2022, two global events have heavily influenced the industry and essentially further exacerbated these trends. First, Russia's invasion of Ukraine, which caused downstream impacts on fuel, drivers, and trucks. With fuel, as Russia is a major global supplier of oil and gas, these actions have further accelerated the supply constraints and therefore drove price increases. Now, regarding drivers, it's estimated that approximately 100,000 drivers in Europe are Ukrainian. And of that population, anecdotally, we know that some drivers have decided to return home or are simply unable to work. placing even greater strain on an already tight market. And finally, regarding trucks, Ukraine is a major supplier of wire harnesses, and together with Russia, major producers of platinum and palladium, all three of these being key inputs into truck manufacturing. Although some of these impacts will take a few months to really be fully felt given current reserves, we already see lower truck production rates. In March, for example, production was down about 5% year on year and 7% from the pre-pandemic levels. And that's all despite, of course, extraordinary demand. The second event, though, was the Omicron wave that began late last year and has hit China particularly hard, with their no COVID approach struggling to curtail the spread. Now, ultimately, this has simply placed even greater pressure on the availability of goods. And we know, for instance, in the US, it's taking an average of roughly 100 days to receive production materials, which is the longest in record dating back to 1987. So if we click one ahead again, in aggregate, this means the bottom line is it's greater costs for carriers to operate, plain and simply, and in turn, greater costs for shippers to move goods. And for shippers, as we know, they're not only facing higher transport costs, but simultaneously feeling cost inflation throughout their P&Ls. For example, inflation in general in April reached 7.5% across Europe. At the end of the day, many shippers are feeling the squeeze on margin and looking for ways to save money and simply operate more efficiently. So for the rest of this discussion, we will dig deeper into the recent fuel trends specifically, highlight how the freight market has developed, and discuss further considerations to keep in mind. So if we go to the next slide, please. As mentioned, I wanted to start by sharing insights on the recent fuel price developments and put them into some historical context. As we see global demand for gasoline, diesel, plastics, they've all risen to record levels since the lows in mid-2020. However, supply has been unable to match that increase, causing Brent crude prices to increase by upwards of 50% within 2021 alone. And as you can see on this chart, diesel prices have largely followed that trend, with the recent events in Ukraine causing price spikes to reach record highs. Now, although we have seen some normalization since the peak in March, it's still a very fluid situation. And I think one particular trend that we are tracking closely is, of course, Russia's production and output trends, as they are key to determining the ultimate impact on global fuel prices. So if we can go to the next slide, it's no secret that Russia is a major global provider of fuel, providing roughly 10% of the global supply of oil. And so any changes in their behavior or further sanctions can have massive impacts on prices. What you see on this chart here is a graph of oil production by Russia over the last 17 years, as measured by satellite tracking of flaring activity at their production sites. In mid-2020, we see that drop in production, of course, related to COVID lockdowns, and then the subsequent gradual rise. Now, news is moving very quickly, so it's important to reiterate that there are many competing factors potentially influencing production rates. For example, before the war in Ukraine, Russian oil accounted for about 1/3 of Germany's supply. And a month ago, Germany had reduced its dependence on Russian oil to about 25% of its imports. Just today, or recently, I believe last week, they announced that it was now 12%. So a very rapidly changing environment that we're seeing. But regardless, any drop in Russian production will affect the global markets. And this trend implies demand will simply not be met with existing supplies. Thus, rates may continue to be elevated or even get worse with potential additional European sanctions that could be implemented. So now I'll pass it over to Nick, who will provide a little bit of context as to what these trends actually mean for the European road freight market specifically. So next slide, please.
Thanks, Brennan. So the net impact of many of the structural changes and trends, the driver and truck availability, rising demand, input shortages, and of course the fuel price spikes, is that road freight rates have continued to increase since the start of the year. So here we're showing normalized prices for the German domestic market, where rates are up 18% year to date and nearly 29% year on year. It goes without saying that the freight market is incredibly volatile at the moment, and we're seeing shippers finding ways to reduce their exposure through a number of methods. One method we've explored is the implementation of a diesel floater mechanism to ensure that freight prices move in line with the market trends. And we're also seeing some shippers delay large tenders and shifting more to the spot market, which we'll highlight more on the next slide. So if we do move to that next slide, please. So here we took a look at posted spot opportunities across 48 shippers on 4 TMS platforms since January 2021. And now on a like-for-like basis, we see that the number of opportunities has nearly tripled. Now, from this data, it's clear that the spot market has become a way for shippers to guarantee continued service whilst waiting for market to normalize before locking in longer-term rates with carriers. And we also see this as a sign of increased number of contract rejections from carriers. Now, certainly from an anecdotal perspective, we've seen many contract tenders postponed due to market volatility. And for shippers, aside from the increased operational workload and poorer service quality from having to resort to the spot market, a larger mix of spot loads typically leads to a higher overall FTL spend for shippers. Now, if we jump to the next slide and we take a step back and look at the broader macro environment, we can get a sense for future expectations. Now, the top line here is the Eurozone Manufacturing PMI, Purchasing Managers Index, which is an indication of business confidence. A score above 50 represents expectations of expansion in manufacturing, while below 50 indicates contraction. The bottom line represents the Eurozone Consumer Confidence Index as reported by the European Commission. These two indicators have a different scales, but have moved in lockstep over the last 14 years through recessions and COVID waves. What's interesting is in 2022, we're seeing a stark deviation developing. Consumer confidence has been tanking down to historic recessionary territory, whilst businesses still seem bullish on manufacturing growth. Now, while it's too early to say definitively, it's very possible that we are fast approaching another recession, or at least dealing with stagflation. There are very real inflationary forces in place, with oil embargoes and commodity shortages that will hurt consumer buying power. And furthermore, governments will likely be hesitant to conduct large-scale spending at risk of accelerating the inflation problem and having just spent heavily with COVID public health policies. Central banks are also tightening monetary policy, which will put further pressure on the European economy. The very small silver lining for shippers, at least, is that this may mean a slight reprieve for a chronically tight road freight market. However, we're still some way off that. Capacity in Europe is better than at the Christmas peak, but still 6% less than the same period last year, according to Transporion. Now, if we jump to the next slide, Brennan will take us looking further ahead.
Thanks, Nick. So looking ahead, there are two regulation-driven trends we continue to monitor. First is the EU mobility package, which went into effect in late February. Now, to date, we haven't really witnessed any material impact on capacity, specifically from the implementation of this regulation. And our belief is that this may be tied to relatively low enforcement on a local level. But if this changes, it could have massive negative implications on capacity, particularly in cross-border, as well as freight markets that heavily rely on non-domestic cabotage carriers. And second, the European Green Deal, and in general transition to net neutral emissions by 2050. Here, while we see the transition to more sustainable energy sources already underway, it will take time to develop the necessary infrastructure required to support a fully non-diesel environment. However, we actually may see some recent events begin to accelerate this transition even more. For example, Russia's invasion of Ukraine has actually encouraged the German government to rethink their transition timeline. And recently they committed to reaching 100% renewable power by 2035. Regardless, for interested shippers, there are fuel alternatives to diesel already on the market available at a price premium, which are becoming an increasingly popular option for shippers looking to meet their own emissions reduction goals. So I hope these insights have been helpful to put the current ever-changing market environment into some context. I will now pass it back to Adeola, who will share some practical suggestions for navigating through this volatility.
All right, thanks so much. So in terms of that, obviously you've seen Brennan and Nick kind of spell out some of these macro trends, a lot of them sometimes being headwinds in terms of volatility, but we do think that digital solutions can provide very effective ways towards building this resiliency. And there's three main areas that we do see this. I'd say the first one is on planning. And I think the very basic aspect of that is really understanding your risk and trying to manage accordingly to that. Using digital solutions to assess and prioritize risk in a dynamic fashion can really help you build a plan, at least in terms of resiliency and understanding what aspects from these macroeconomic trends can most impact your business. Second aspect around planning would be actually understanding your business mix, specifically around the pricing aspect. If you proactively evaluate your spot or tender rate mix, and again, to do this on a dynamic basis, this can also help you stabilize your forecasted pricing impacts specifically on your business. I'd say the second area where we truly see some digital tools really helping build resiliency is around optimization and really around kind of automation. The benefit of using digital solutions and making sure that what you're building is really repeatable, but can be optimized in a very succinct and easy way. So automating order processes and can help eliminate workflow redundancies. But most importantly, when you have integrations of your systems, so API or EDI connections to your ERP and TMS systems really can help you reduce your transport processing times and costs. And what we've typically actually seen in terms of our platform is that for shippers that use sennder, we can see cost reductions of up to 19% and then CO2 emissions reductions up to 20%. So even in some of those areas, by just using digital tools, you really can see the impact of optimization. And then last is transparency, making sure that you have visibility of your shipments across the entire delivery lifecycle. GPS tracking is, of course, one of the main solutions to do this, where you can get real-time visibility to pinpoint bottlenecks, any downtimes along the delivery path. One of the great things also about sennder is that we typically work with carriers that can give up to 5 times more visibility from GPS alone than traditional freight forwarders. So again, digital solutions can also augment some of the gains that you'll see with GPS integrations. And then the last aspect is really starting to think more creatively around partnerships and building maybe more hybrid partnerships that you have, thinking about expanding 3PL plus models, for instance. They can offer more consistent tracking across a breadth of your shipments and deliveries. So as an example, through the offering that we have at sennder, which we title Control Tower, which is our 3PL offering where we can take over significant portions of visibility for shipment defined lanes. We have actually worked with our customers in this capacity to help, again, reduce costs by roughly 6%, but ultimately improve delivery performance time by up to 31%. So here are just, again, some really critical tactical ways in terms of using digital solutions to help you navigate through some of these uncharted times. So with that all being said, we'd love to turn this over in terms of the Q&A aspect of this. So again, like I mentioned before, please feel free to add any questions into the Q&A and we'll be able to respond to those accordingly. And I guess one question that I can kind of kick off with, which kind of came through, and maybe I'll address this to you, Brennon, is given the kind of overall context of what you're seeing, one area that we hadn't really broken this down into is really thinking about the impact of FTL versus LTL. So do you see any differences in terms of this volatility for FTL or LTL, or even from an overall aspect in terms of growth from road freight logistics?
Yeah, sure. I think the volatility aspect really affects the market holistically. However, what we've seen is in particular with FTL, I think with more shippers searching for guaranteed capacity, that FTL growth has incrementally risen as a result of shippers looking for more certainty. Nevertheless, I think with the LTL market specifically, it still accounted for roughly 70% of the total market. And by 2025, estimates still put that at about 71 or 72% of the total market. So still a substantial amount of volume through LTL channels. And of course, barring any additional COVID setbacks or other rapid onset of recessions or anything of that nature, we do expect that the European road freight market will be virtually recovered by end of year. However, at that point, it will still be roughly maybe 1 to 2% smaller than it was in 2019. And now, those same analyst estimates by 2025 put the market estimated to be at roughly 10% larger than 2019, and to reach a total size of about 378 billion.
Got it. And another question that's kind of come through is actually about some of the opportunities around green. So this was something that you mentioned, if we kind of take a step in terms of looking ahead, we know that that's maybe not where we are today, but if we can look 5, 10 years into the future, green is going to be more of a significant portion of road freight logistics. Can you explain a little bit more in terms of what are some of the options around green opportunities, green business, and specifically within road freight logistics?
Absolutely. Yeah, I'd say today the primary options that shippers have are primarily around alternative fuel options. And so transport companies today, including sennder, do offer green fueling alternatives to diesel. And I would kind of split this up in between the process and the availability aspects. So on the process side, shippers can reduce the barrier to entry to adopting green fuels by simply better understanding during the tendering process how to capture information around costs and emissions. And for example, by allowing the option for transport companies to submit separate prices for alternative fuel types, this can allow shippers to then properly evaluate the combination of price and carbon emission reductions implications for each fuel type. And to be specific around the options that sennder offers, we offer 4 different green fueling options today. And those are 2 types of biodiesel, HVO or hydrogenated vegetable oil, and B100, both of those made from oil derivatives, vegetable or other oil waste products. And by utilizing these fuel options, you can reduce emissions between 60 to 90% of fossil fuels. But in addition to that, we do also offer CNG or LNG, and those are compressed or liquefied natural gases. And those can also help to reduce emissions by in the range of about 10 to 20% versus fossil fuels. So those are the options that are on the market today already. And I think one limiting factor for more shippers to be able to adopt these sort of solutions is simply geographical access and where that infrastructure is set up of fueling stations, et cetera, for these types of fuels. For example, we've recently launched a new initiative, which is HVO Flex. And this is an emission reduction solution for shippers who want to reduce their emissions on lanes, but if those lanes have limited access to HVO advanced fuels, they've historically been unable to. So for these shippers, they can reduce emissions by selecting HVO Flex, and then we would search within sender's network for green shipments and be able to then apply those reductions to the shippers, irrespective of which specific lanes we are currently operating in for them.
Fantastic. All right, we've seen a few more questions kind of come through, so we'll see if we can kind of tick through some of them. The first one that was recently added was, why do we think we are able to reduce our CO2 emissions by 20%? So what we're seeing in terms of using the sennder platform, how are we kind of seeing this in terms of freight cost savings? So what are the ways that we're working with our shippers to specifically reduce emissions and also reduce cost savings?
Absolutely. So I think it goes without saying that using green fueling options absolutely is one way that we can help to reduce these emissions. And the 20% figure that Adeola quoted also takes into account a more optimized network. So when we can reduce empty miles for trucks, we can effectively then reduce the amount of emissions, even if those emissions or those trucks are using traditional fossil fuels. And so that 20% is a combination, of course, of both more optimized truck movements as well as more green fuel options.
Great. And then I see that there are some questions around regulations. I know we touched on this briefly in terms of the EU mobility package and saying that right now there hasn't been much enforcement. But if we do see changes in regulation, maybe even just more enforcement of the EU mobility package, what do you think are the actual potential impacts in the short and long term?
Yeah, it's a good question. I mean, I think in the short term, the mobility package will cause some unnecessary empty miles to be undertaken. I think it goes without saying. One company we spoke with is chartering a train to return vehicles to Romania to cross the border and then send them immediately back to Western Europe for operation. And that's just one example. I think the results will be thousands of empty miles that will need to be driven in order for trucks, particularly from countries in Eastern Europe like Romania, Bulgaria, the Baltics, to return to their home base at regular intervals. And given that these are primarily export markets, I think we can expect freight rates on eastbound rates to actually fall considerably as carriers are increasingly searching for anything that can get them back home. And for Western European markets, I think you'll just see simply greater freight rates for those longer haul Eastern to Western European flows. I think in the long term, however, it's still difficult to say, but what we might see is more companies setting registrations closer to their areas of operation. And ultimately, this could in the medium and long term have some positive effect on emissions because it would incentivize more local transports and more likely also better working conditions for workers, so they'll be able to live and work in relatively the same areas and spend more time with family. Also, the complex rule set that we see being implemented, I think will leave sennder, for example, or any tech-enabled businesses in a better position to manage through that turmoil. For example, specific to the e-mobility package, with digital tachographs integrated with GPS, which will be a requirement in, I believe, 2023. Those types of visibility solutions and working with more digital tech-enabled businesses will enable a smoother transition into that environment.
And then one tag-on question around, again, maybe some more of the regulatory aspect of this. Given some of the changes with EU mobility package, potentially impacting the types of trucks and vehicles that we're using, do we think that there will be any regulations around using more extra long vehicles or even just different vehicle types in more countries to kind of also address some of these concerns around mobility, just so that, again, we can kind of cover as many transports within one tour? Do we think that's going to be one of the aspects that could be impacted with regulations?
Yeah, I think it's difficult to say at this state, although what we have seen already is, as I mentioned before, potentially not necessarily requiring different truck types, but rather shippers and carriers searching for different modalities, for example. So intermodal, more rail movements that can effectively, more efficiently move capacity at more efficient, more optimized ways. But yeah, I would say that I don't think we've seen any signals of any other particular regulations centered around truck types in particular, and I wouldn't expect to see that in the near term. But speaking of vehicle types, particularly as it relates to emission reductions, I think we will see a shift to electric vehicles. Now, I think we're years away from really seeing that adoption fully, partially the fact of a lack of infrastructure, but also the fact that these types of trucks will cost more for our carrier, and particularly for smaller carriers trying to pay 2 to 3x the price of a regular truck, I think will be a barrier to entry that will slow the adoption more.
Got it. And you just touched upon this, but I think this is all we have time for in terms of the final question. But it was around multimodal transport. But do we think that multimodal transport can help increase capacity, or would it simply just cannibalize against and reduce against road transport in some segments?
Yeah, I mean, I think it is definitely location or geographically specific. But in general, I do see that as more adoption of intermodal or type of offerings are adopted potentially as a reflection of the more stringent implementation of the mobility package. I think you'll see that greater adoption will lead to greater investment into those other channels. So I do see it as additive in terms of adding capacity in the market, but still, I think it's an oversimplification to say across the board, and we'll have to see.
Yeah, maybe just to add on to that, you are always going to be slightly constrained by the fact that your intermodal, if you're going by a train, is not going to get you delivered to the warehouse or factory where you need to go. So you're still constrained by the truck supply. And we've also seen a kind of decline in intermodal from places like importing from China going through Ukraine was a major train line into Europe. And clearly with the disruption there, that's no longer possible. So there's been almost a decline in some parts of capacity on the network.
A fair insight, especially with, again, what's happening with the Ukraine crisis. All right, I think we are right at time. I really appreciate everyone for joining us today. We will actually be sending out this recording, so if there's, for any reason, anything that you missed, you'll definitely be able to have these insights afterwards. Thanks again for joining today. I'd like to also thank Nick and Brennon for many of their great insights. And again, we look forward to having more of these sessions and sharing more of our insights. Thank you so much, and take care.